For decades, the notion that you need a small fortune to start investing has been perpetuated by financial experts and media outlets. People believe that $10,000 is the minimum threshold for serious investing, anything less being relegated to penny pinching or amateur hour. However, this mindset couldn't be further from the truth. In 1993, Peter Lynch, then a young fund manager at Fidelity, proved just how wrong this narrative was. With an initial investment of $10, he went on to turn it into over $14 million. This staggering return wasn't limited to exceptional market conditions or inside information. It was simply the result of smart investing strategies and discipline. Lynch's feat is a stark reminder that anyone can invest seriously, regardless of their starting capital. The notion that you need an eight-figure sum to make a meaningful impact in the financial markets is nothing more than a myth perpetuated by those who profit from keeping people uninformed. We've all heard the excuses, "I'm not smart enough," or "I don't have the time." But the truth is, investing isn't rocket science. With the right education and strategy, anyone can create wealth regardless of their income level or financial background. In fact, Peter Lynch's success was largely due to his ability to identify undervalued stocks and small-cap companies. By leveraging these hidden gems, he consistently outperformed the market and delivered impressive returns for his investors. But here's the thing, you don't need to be a genius like Peter Lynch to replicate this kind of success. With the right tools, knowledge, and approach, anyone can turn their initial investment into a small fortune. And that's exactly what we're going to show you in this video, a proven investment strategy that can help you turn $1,000 into $10,000 or more. In the world of investing, it's a common misconception that you need to have a substantial amount of money to start building wealth. But what if we told you that it's possible to turn a relatively small initial investment into a life-changing sum? Peter Lynch, one of the most successful investors in history, is a prime example of this phenomenon. It was 1993 when Peter Lynch made headlines by turning an initial investment of just $10 into over $14 million. Yes, you read that right, $10 to $14 million. This incredible feat not only stunned financial experts but also raised eyebrows among the general public. How did he do it? It's simple, through a combination of smart investing strategies and a thorough understanding of the markets. But Peter Lynch is no anomaly. His story is a testament to the power of compound interest and disciplined investing. By investing in companies with strong fundamentals, such as Johnson & Johnson, Procter & Gamble, and Gillette, he was able to reap significant rewards. In fact, his success with Fidelity's Magellan Fund earned him a reputation as one of the greatest investors of all time. What's more, Lynch's investment strategy is surprisingly accessible. He didn't require millions of dollars to invest. Instead, he used what's called dollar cost averaging, a technique where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach not only reduces risk but also allows for steady growth over time. So, can you replicate Peter Lynch's success? Absolutely. While his returns may be exceptional, the underlying principles he employed are within reach of anyone willing to put in the effort. In fact, many experts believe that with a solid understanding of investing and a bit of discipline, it's possible to turn an initial investment of $1,000 into a substantial sum, even as high as $10,000 or more. We'll explore this strategy in greater detail throughout our video series, so stay tuned. It's a common misconception that you need a large amount of capital to start investing seriously. However, Peter Lynch proved this notion wrong when he turned an initial investment of $10 into over $14 million in just 30 years. Lynch's remarkable journey serves as a testament to the power of long-term investing and a well-thought-out strategy. But what exactly contributed to Lynch's astonishing returns? A closer look at his approach reveals that it was rooted in meticulous research, a keen understanding of market trends, and an unrelenting commitment to diversification. By focusing on undervalued stocks with strong growth potential, Lynch managed to capitalize on opportunities that others often overlooked. One key development in Lynch's strategy was the introduction of the Magellan effect. This innovative approach involved investing not just in individual companies but also in entire sectors and industries, thereby spreading risk and amplifying returns. By doing so, Lynch created a diversified portfolio that was resilient enough to withstand market fluctuations. Lynch's results were nothing short of remarkable. His fund, Fidelity Magellan, grew from $18 million to over $14 billion under his management. This meteoric rise caught the attention of investors worldwide and cemented Lynch's reputation as one of the greatest fund managers of all time. What can we learn from Peter Lynch's success? Firstly, it's essential to adopt a long-term perspective when investing. By resisting the temptation to try and time the market or make quick profits, you'll be better equipped to ride out market fluctuations and capitalize on opportunities that arise over the course of several years or even decades. Secondly, diversification is key. By spreading your investments across various sectors and industries, you'll reduce risk and increase potential returns. This doesn't mean simply throwing a wide range of stocks into your portfolio. It requires careful research and analysis to identify areas with strong growth potential. Lastly, Lynch's success demonstrates the importance of staying informed and adaptable in the face of changing market conditions. By continually educating yourself about various industries and sectors, you'll be better equipped to respond to new developments and capitalize on emerging trends. It's essential to note that Lynch's approach is not without its challenges. He spent countless hours researching companies and analyzing financial data before making investment decisions. It also required a significant amount of emotional discipline to resist the temptation of quick profits and stay focused on long-term goals. As we explore this investment strategy further, it will become clear that turning $1,000 into $10,000 is not only achievable but also requires a combination of sound research, a willingness to adapt, and an unwavering commitment to your goals. The strategy that Peter Lynch employed to turn $10 into $14 million is rooted in fundamental principles of value investing. He didn't rely on get-rich-quick schemes or leverage high-risk trades, but rather focused on understanding the inner workings of companies and identifying undervalued assets. One of the key aspects of his approach was a deep dive into financial statements, looking for discrepancies between a company's reported earnings and its actual cash flow. By doing so, he was able to uncover hidden gems that were being overlooked by other investors. Take, for example, the case of Wendy's International in the 1980s. Peter Lynch noticed that despite impressive sales growth, the company's stock price remained stagnant due to a perceived mismatch between earnings and cash flow. He recognized an opportunity to invest in a fundamentally sound business that was undervalued by the market. Lynch's ability to identify such mispricings allowed him to generate significant returns over time. His 20-year tenure as manager of Fidelity's Magellan Fund yielded annual returns of nearly 29%, outperforming the S&P 500 index by a wide margin. However, it's essential to note that Lynch didn't solely rely on individual stock picks to achieve his success. He also applied a thorough understanding of market trends and industry dynamics to inform his investment decisions. This holistic approach allowed him to navigate periods of high volatility and capitalize on emerging opportunities. The implications of Peter Lynch's strategy extend beyond the realm of finance, as it highlights the importance of patience, discipline, and critical thinking in achieving financial success. By combining rigorous research with a long-term perspective, investors can unlock significant gains even with modest initial investments. As we dive deeper into the world of investing, it's essential to understand that breaking free from conventional thinking is crucial. Most people believe you need a substantial amount of capital to start investing seriously, but that's simply not true. Take Peter Lynch, for instance. In 1993, he made headlines by turning an initial investment of just $10 into over $14 million with his Fidelity Magellan Fund. Now, I know what you're thinking, this is an extreme example, and it's unlikely you'll replicate such success with a small amount of money. However,